When you're rich enough, laws aren't obstacles. They're just mildly inconvenient riddles. 1. The billion-dollar yacht. That legally didn't exist. In the early 2000s, a Russian oligarch found a brilliant way to dodge yacht taxes by claiming his 400-foot floating mansion technically didn't belong anywhere. He registered it under a shell company in the Cayman Islands, leased it to another shell company in Malta, and insured it through a third in Bermuda. So when European tax authorities came knocking, each country shrugged and said, "Not our boat." It was a bureaucratic Bermuda Triangle where common sense went to die. The yacht had a helipad, a submarine, and a Picasso, but legally, it was just a temporary marine research platform. The loophole was so airtight that lawyers called it yacht invisibility. Only billionaires could invent a way to own something so expensive it legally vanishes. 2. The CEO who rented his own house to himself. In the 1980s, one California millionaire pulled off a tax trick so absurd it sounds like a Reddit prank. He transferred ownership of his $10 million mansion to a company he owned, then began paying himself rent from that same company. Technically, it was a business expense. Practically, it was financial inception. The IRS couldn't touch him because on paper, the tenant and the landlord were two entirely different entities. In reality, he was just paying himself to live in his own house. When an auditor asked why he'd send rent checks to his own address, he replied, "Because that's where I live." The loophole eventually got closed, but not before the rich guy literally cashed in on the weirdest version of paying rent to yourself. 3. The oil baron who became a monk for tax reasons. In 1977, a Texas oil tycoon faced a mountain of taxes he didn't want to pay. His solution? Religion. He founded the Church of Eternal Abundance, appointed himself as High Reverend, and immediately declared his oil fields as sacred land. Under U.S. law, religious property is tax-exempt, and this guy turned it into the holiest petroleum operation on Earth. He even built a tiny chapel in the middle of an oil rig, complete with a neon cross and a donation box labeled tithes or gas money. The IRS investigated but had to admit, the law didn't define what wasn't a religion. So, for 5 glorious years, his church literally ran on crude oil and faith in creative accounting. God bless the loopholes. 4. The billionaire who claimed his mansion was a farm. When you picture a farm, you imagine cows. Hey, maybe a tired farmer in overalls. What you don't picture is a $50 million mansion with marble fountains and imported olive trees. But in New Jersey, one billionaire managed to classify his 60-acre estate as a working farm to dodge property taxes. His secret? He let a local beekeeper put 2 hives on his lawn. That's right, a few bees transformed a luxury palace into an agricultural operation. Under the state's farmland tax law, owning any form of commercial agriculture qualified you for massive discounts. So while normal families paid thousands in taxes, this guy paid less than most people's water bill. When reporters asked how often he checked on his bees, he smiled and said, "They're independent contractors." It's the only time in history someone got rich by letting insects do his paperwork. 5. The rich heir who lived in an airport. Legally tax-free. In the 1990s, a European millionaire found the ultimate tax loophole. No country, no taxes. He sold his mansion, packed up his assets, and lived in international airport lounges for 5 years straight. Since he never stayed in one country long enough to be considered a resident, no government could legally charge him income tax. He'd fly from Zurich to Dubai to Singapore, living entirely in transit zones, technically belonging to nowhere. He even bragged about it in interviews, sipping champagne in first class while calling himself a citizen of Terminal 3. The loophole worked until airlines started noticing he never actually left the airports. Eventually, one country revoked his visa mid-flight, forcing him to land in tax reality again. For 5 golden years, he literally lived between nations, a millionaire ghost haunting airport lounges with a gold card. 6. The millionaire who bought a town to fire his taxes. Most people move to cheaper cities for tax breaks. One oil magnate in the 1980s decided that wasn't efficient enough, so he just bought an entire town. A dusty little Texas settlement with 11 residents and 1 diner became his personal jurisdiction. Once he owned every building and piece of land, he appointed himself mayor, rewrote local property laws, and conveniently slashed his own tax rate to nearly 0. When journalists asked if this was legal, He grinned and said, "It's democracy with better management." His self-governing town technically followed all state laws but funneled revenue right back to his own companies. The IRS eventually stepped in, but by then he'd sold the town to another businessman who used the exact same trick. Turns out, buying your own zip code is cheaper than hiring an accountant. 7. The Hollywood producer who claimed his yacht was a movie set. When you're a Hollywood mogul, even your vacations need a plot twist. In 2011, one producer got caught writing off his $12 million Mediterranean yacht as a film production expense. His logic? He occasionally held creative meetings on deck. Therefore, the yacht was a legitimate shooting location. The IRS wasn't amused until his lawyer showed up with photos of him holding a camera and a script during a cocktail party. Legally, that counted as production activity. So his weekend booze cruise became a business trip, his bartenders became crew, and his hangovers were creative fatigue. The loophole saved him millions and inspired other executives to hold board meetings on their private islands. Apparently, if you call your vacation a production, the government calls it art. 8. The tech billionaire who became a homeless investor. In a move that redefined absurdity, a Silicon Valley billionaire realized he could dodge capital gains taxes by claiming he had no permanent residence. He sold his $30 million mansion, moved into luxury hotels, and declared himself technically homeless. Since the IRS defines residency as a fixed address, he argued his income had no taxable location. For 2 years, he lived out of designer suitcases, rotating between penthouses, yachts, and temporary rentals in Monaco and Dubai. When asked if he missed having a home, he said, "I have 7, I just don't live in any of them." Eventually, the loophole was exposed, but not before he legally filed as an unhoused individual with offshore interests. Only in the modern world can a man own 7 properties and still qualify as homeless, at least on paper. 9. The CEO who paid himself in cows. In the 1970s, a South African mining executive discovered a tax loophole that let him avoid income tax by getting paid in livestock. The government taxed cash, not in-kind assets, so his company started compensating him with cattle instead of checks. Every month, truckloads of mooing paychecks showed up at his ranch. He'd then sell the cows to a subsidiary he also owned, essentially transferring his salary without ever technically receiving income. By the time auditors caught on, he'd earned the equivalent of $5 million in beef. When asked if this was ethical, he shrugged and said, "I'm just diversifying my portfolio." The loophole was eventually closed, but not before inspiring a short-lived trend among executives who suddenly decided they were part-time farmers. It was capitalism meets barnyard absurdity, proof that when the rich smell a loophole, they'll milk it. 10. The millionaire who lived on a cruise ship to dodge taxes. In 2008, a retired software tycoon sold his company, cashed out hundreds of millions, and immediately booked a permanent cabin aboard a luxury cruise liner. Why? International waters are tax-free. The ship sailed under a Liberian flag, and since he technically spent more than 330 days a year outside any single country, he legally qualified as a non-resident. His home address became Suite 804, Deck 9. He had staff, Wi-Fi, and even mail forwarded to ports. For 7 years, he floated through sunsets while accountants scrambled to verify where exactly his income existed. Governments called it tax evasion. His lawyer called it geographical optimization. The loophole closed only when the ship changed registry, ending his voyage of tax-free living. He left with a tan, a grin, and the world's most expensive P.O. box. 11. The billionaire who claimed his art was in transit forever. One European collector found the perfect loophole to keep his priceless art tax-free by never letting it arrive. He stored hundreds of millions in paintings inside an airport freeport, a legal gray zone between customs and national soil. Technically, the art was in transit, even if it sat there for decades. No import taxes, no duties, no scrutiny, just Monet and Picasso chilling in a glorified warehouse. Inspectors couldn't do anything because legally, the art hadn't entered any country. When asked if he ever missed seeing his collection, he said, "Sometimes I visit my airport." The man literally turned customs law into a museum for billionaires. To this day, some of the world's greatest masterpieces are technically stuck in perpetual layover, flying under the radar of taxation forever. 12. The heiress who married herself for financial benefits. In 2015, an eccentric British heiress found that marital tax deductions offered huge savings. But she wasn't about to share her fortune. So she hosted a lavish wedding where the groom was herself. The event had vows, rings, and even a legal officiant who filed it as a symbolic union. When she claimed the marriage tax benefits, the government's computer system didn't know how to reject it, because the form didn't ask to whom she was married. For 3 years, she received married couple deductions while living blissfully alone in her mansion. When the loophole was finally caught, she defended it by saying, "Technically, I am in a committed relationship with my assets." Authorities quietly changed the tax form afterward. It's the first time in history someone managed to get a honeymoon and a tax break without ever saying "I do" to anyone else. 13. The investor who moved his mansion. 2 feet to evade law. In 1999, a real estate tycoon in Florida discovered that local property taxes skyrocketed the moment a home was considered oceanfront. His mansion? Exactly on the line. The solution? He literally hired engineers to move the entire 10,000 square foot house 2 feet backward. Once it was technically no longer oceanfront, his tax bill dropped by $500,000 per year. When inspectors came by, he handed them blueprints, proving the new coordinates. "It's not beachfront," he said, "it just has excellent views." The stunt was so precise that the property boundary had to be redrawn, leaving the government furious but powerless. They eventually rewrote the law, but he enjoyed 6 years of beachfront living at non-beachfront prices. It's the only time real estate fraud required both cranes and geometry homework. 14. The banker who claimed his bonus was performance art. In 2013, a Wall Street banker made headlines for classifying his 7-figure bonus as an artistic performance fee. He argued that the high-pressure world of finance was a live, expressive act, and therefore his annual bonus qualified as creative income. That distinction carried lower tax rates reserved for artists and performers. The IRS challenged it, until his legal team presented a 300-page philosophical defense comparing stock trading to abstract emotional improvisation. Against all odds, the court partially agreed. His bonus could be partially considered artistic compensation. The loophole was quickly closed, but not before he became an accidental icon for every accountant who ever doodled during tax season. For one brief, shining moment, capitalism itself was declared art, and the tax code had to applaud. 15. The real estate mogul who declared his mansion a church of capitalism. In 2006, a Las Vegas developer converted his palatial estate into a religious institution called the Church of Capitalism, complete with marble altars to market forces and a golden bull statue in the foyer. Under Nevada's tax law, registered churches were exempt from property tax. So he became both founder and high priest of his personal religion, hosting weekly services that consisted mostly of cigar smoke and PowerPoint slides on free enterprise. When questioned by auditors, he produced sermon transcripts with titles like The Gospel of the Dow Jones. The IRS eventually cracked down, but he still got 3 years of tax-free worship at the altar of his own ego. It's hard to say whether it was genius or blasphemy, but it was definitely profitable salvation. 16. The millionaire who declared his mansion a wildlife sanctuary. In 1995, a retired banker in Connecticut decided he was done paying luxury property taxes on his 40-acre estate. So, he pulled the most eco-friendly tax dodge in history. He declared his land a wildlife refuge. His contribution to conservation? Releasing 3 ducks into his swimming pool and planting a few tomato vines he called native flora. Under the state's environmental preservation law, his estate instantly qualified for a 98% property tax reduction. When reporters visited, they found the habitat included a heated tennis court, a helicopter pad, and one very confused gardener wearing binoculars for show. The loophole stayed open for nearly a decade until the state rewrote the law to require proof of biodiversity. The man reportedly released 6 more ducks as evidence. Environmental hero? Not quite. Financial genius? Absolutely. 17. The heiress who turned her closet into an art gallery. When the ultra-rich get creative, accountants weep. One Manhattan heiress realized that art galleries received massive tax deductions for public cultural spaces. Her solution? She turned her walk-in closet into a micro-gallery. The gallery featured exactly 3 paintings, 2 velvet ropes, and a small sign reading, open by appointment only. The only visitor ever recorded was her housekeeper, who dusted the exhibit once a week. Despite the obvious absurdity, the tax authorities had to honor the claim because, legally, her closet was open to the public. When investigators asked for proof of public access, she handed them a guest book with one signature, her own. It took lawmakers 2 years to close the loophole, during which time she wrote off tens of thousands in gallery maintenance. It was the world's smallest museum and the most profitable closet in history. 18. The billionaire who claimed his jet was educational equipment. In 2010, a Texas oil magnate avoided millions in taxes by claiming his $40 million private jet as an aerospace educational tool. He argued that, since he occasionally let his son's high school science club tour it, the aircraft qualified as educational equipment. On paper, the jet became a learning resource, complete with field trips that looked suspiciously like family vacations to the Bahamas. He even wrote off the minibar as student hospitality. When an IRS agent challenged the claim, the billionaire's lawyer presented photos of teens posing beside the jet in safety goggles. The case was dropped. Technically, the law didn't specify how often something had to be used for education. For 2 glorious years, his beach getaways were STEM enrichment experiences. It turns out the only real science experiment was how far he could stretch the definition of learning. 19. The lawyer who sued himself for profit. In 1986, an Oregon attorney found a strange loophole in civil liability law. If a person caused themselves harm while working, insurance could pay for personal damages. So he filed a lawsuit against himself. He argued that as both employer and employee of his private firm, he had failed to provide a safe working environment for himself. He technically lost the case, but won in the process. His malpractice insurance covered all legal fees, and his accountant reclassified the entire ordeal as a deductible business expense. In short, he spent 6 months suing himself into a tax refund. When questioned by reporters, he said, "It's not insanity, it's innovation." Lawmakers rewrote the statutes the following year, presumably while trying not to laugh. He may not have won the case, but he definitely won the system. 20. The millionaire who claimed his mansion was haunted to lower value. When property taxes skyrocketed, one clever homeowner in New Orleans came up with a chillingly brilliant idea. He declared his mansion haunted. Using an obscure clause that allowed reductions for stigmatized properties, he filed documentation citing verified paranormal disturbances. He even hired a local psychic to confirm that ghosts rendered the home unfit for full habitation. The tax board, bound by its own absurd rules, granted him a 30% property devaluation. Tourists later learned about the haunting and began showing up nightly, so he started charging $50 for ghost tours. He earned more in a year from tickets than he ever paid in taxes. When officials finally revisited his claim, he defended it with a grin. Prove it's not haunted. To this day, locals call it the only house in Louisiana that turned fear into a business plan. 21. The investor who became stateless to dodge capital gains. In 2018, a tech investor pulled off a tax escape act that made even his lawyers nervous. He renounced his U.S. citizenship, but instead of adopting another, he chose to be stateless. With no official nationality, he claimed no government had the authority to tax him. He moved between yachts, private jets, and rental islands, never spending more than 60 days in any country. The U.S. IRS tried to claim he owed an exit tax, but his lawyers argued that since he didn't technically belong anywhere, there was nowhere to send the bill. For nearly 3 years, he lived in limbo, a passportless billionaire ghost drifting between international waters and embassies. Eventually, he accepted citizenship in Monaco, ending his nomadic adventure. Until then, he'd achieved the impossible, being rich everywhere and taxable nowhere. 22. The millionaire who declared his pool a reservoir. In 1994, a Beverly Hills millionaire realized his property taxes could drop if he could prove part of his land served a public utility. His light bulb moment? He reclassified his Olympic-sized swimming pool as a water reservoir. He argued that it was technically part of the city's emergency water storage system, since, in theory, firefighters could use it during a drought. He even added a brass sign that read, "Beverly Hills Hydration Reserve, established 1994. The city council didn't buy it, but the assessor's office did, reducing his taxes by 40%. For nearly a decade, his private pool was legally recognized as a municipal water source. The loophole finally closed after a new inspector noticed the reservoir was heated to 86 degrees and surrounded by cabanas. The man's response? The water's warm because we care about climate efficiency. Only in America could a pool party double as civic service. 23. The billionaire who claimed his horse was a company vehicle. In 1979, a Texas oil executive found an oddly legal way to write off his polo habit. He classified his championship horse, Thunder Prophet, as a company vehicle used for promotional purposes. Since his firm sponsored charity polo events, the horse technically counted as advertising equipment. That allowed him to deduct stabling, travel, and even grooming costs, nearly $500,000 per year. The IRS questioned how a horse could be a vehicle. His lawyer coolly replied, "It has horsepower, doesn't it?" The loophole held. To celebrate, the executive had Thunder Prophet photographed next to a Rolls-Royce, calling them fleet partners. The trick eventually inspired a wave of creative accountants who began classifying yachts as floating billboards. When asked if this was fair, he said, "Of course, it's not about wealth, it's about interpretation." 24. The heiress who used her dog as a tax shelter. In 2012, a Manhattan socialite with more money than empathy decided her Pomeranian should own her assets. Using a trust loophole, she legally transferred $30 million to a foundation in the care of her dog, Fluffington III. The foundation covered all caretaking expenses, including a penthouse suite, chauffeur, and a live-in chef who made the dog's meals from scratch. The IRS couldn't touch it because technically it was a charitable foundation supporting an animal welfare cause. When questioned, her lawyer produced a mission statement describing Fluffington as an ambassador for canine luxury awareness. For 5 glorious years, the heiress paid virtually no taxes while her dog lived like a tiny, furry monarch. When the loophole was closed, Fluffington was reportedly furious, though sources say he quickly adjusted to life with only 2 butlers instead of 4. 25. The businessman who declared bankruptcy, on paper only. In the early 1980s, a real estate developer in Chicago found himself drowning in debt, at least publicly. Privately, he was fine. He discovered that under old bankruptcy laws, declaring insolvency didn't require immediate proof of liquidation. So, he filed for bankruptcy, wiped millions in debt, and quietly moved his fortune to offshore accounts under shell companies. Then, using those same shell companies, he bought back his own properties at foreclosure auctions, at a fraction of their value. By the time investigators pieced it together, it was too late. Everything was legal on paper. "It's not fraud," he told reporters. "It's just a very organized comeback story." His strategy became legendary in financial circles, known as the Phoenix Scheme, because it involved burning everything down just to rise again, wealthier. 26. The billionaire who claimed his island was a research lab. In 2015, a Silicon Valley billionaire bought a private island in the South Pacific and promptly declared it a technological research facility. That status exempted him from certain international property taxes and environmental restrictions because it was technically for innovation. The research? A handful of drones, 2 interns, and a single Wi-Fi router. He even renamed the island Project Beta. For 5 years, his private beach parties were legally logged as corporate conferences. The local government finally investigated after noticing that the research staff was a rotating cast of supermodels. His defense? "We're studying human interaction in stress-free environments." The tax office rolled its eyes but couldn't prove fraud. He eventually sold the island for triple its price, proving that if you call paradise a lab, the only experiment that matters is profit. 27. The investor who bought a bank to lend to himself. In 1988, a Florida developer discovered the ultimate financial cheat code. He bought his own bank. By owning a small community bank, he could issue himself loans under a corporate entity, claim the interest as business expenses, and technically owe himself money. His company borrowed millions, defaulted, then forgave the debt, since he controlled both ends of the transaction. The loophole wasn't illegal, just disturbingly creative. He called it vertical financial integration. Regulators eventually shut it down, but not before he built 3 resorts and a golf course entirely funded by his own loans. When asked about ethics, he said, "If the bank trusts me, who am I to disagree?" The loophole was closed in 1991. But by then, his personal fortune had already multiplied tenfold. Money can't buy happiness, but it can definitely rent a few loopholes.